All right. Math and Mortgage Guy. Live Q&A every Monday, 6 p.m. Pacific Standard Time. I reserve the right to change that, by the way. I think with lots of Kings games here in Sacramento falling on Monday nights, I might have to go 4 Pacific Standard Time so I can make it some Kings games. I know they're not that good. It's good memories for me and my sons. I went to Arc Arena in the 80s with my grandma. I watched the Kings lose over and over again. Still great memories. My boys are going to have similar memories of going with their pops and watching the Kings lose game after game. 15 or 16 straight seasons without making the playoffs. Gosh, what bad luck, right? Having a professional basketball team this bad. It's all right. We're gonna turn things around. Enough about the Sacramento Kings. Let's talk about mortgage. Let's talk about real estate. I wonder if I don't have these things on. For some reason, it's weird not hearing myself speak. Let me know if there's any feedback, if there's anything. I don't think there should be any issue with me not wearing those things. Anyhow, get your questions ready. Let's talk about whatever you want to talk about. I just brought up some stuff in case you guys didn't have questions, just to kind of poke around what's going on the interwebs, what they're talking about. I always find this interesting, right? Like the hottest housing markets and like stats and big numbers are exciting to people. So I get that's what sells, but it feels like, I don't know. It's almost like politics. You got some people on one side and some people on the other, and both are trying to state their case. Some people are like, housing is crashing, don't ever buy. Other people are like, real estate, an asset in an inflationary environment, buy. I think I sit somewhere in the middle, right? I love real estate. I'm bullish on real estate. It's not always the right time to buy your primary. Every deal is not a great deal as an investment, but for sure, I don't see anything that these crash dum-dums are talking about. Anyhow, enough about me and my thoughts. Let's see what kind of questions you guys got. Good evening, Mr. Kevin Hawthorne. Good to see you, brother. Appreciate having you here. Familiar names and faces. I like it. That's why I keep coming back every week. Another familiar name and face. Hey, Evan, let's go. Thank you for the kind words. You lost a few houses already, even going 15K above ask. I'm giving up, and I'm here in Michigan. Don't give up, bro. It is going to happen. Every market's different, so I can't speak to specific parts of Michigan. But I will tell you the same sentiment I've heard from clients of mine. And we've got at any given time 100 plus folks fully pre-approved, able to buy. So any given weekend, there might be 10, 12 offers being written, or 10 or 12 different people writing an offer. And we've gone through a stretch where, people used to write offers and get them accepted 80% of the time. Now you write an offer and you get accepted 10% of the time. So it's tough, but it's not impossible. And every market's going to behave differently. I really feel like I'm seeing more and more stuff get accepted without looking into data. I've got enough client data and enough just like what I feel and see in my own business to know that it's getting easier. It's not easy, but it's getting easier. So let's answer your quick question. You owe $1,000 in state taxes from a year ago. Should I pay that off before I find a house? Will they find out about it if I pay it or not? That's a really good question. For sure, if you have outstanding federal tax debt, lender's going to find out about it and want you to be on a payment plan or have it paid off. Since it's only $1,000, I think you should pay it off. As far as if they'll find out if they'll make you pay it off, I'm not certain, so I don't want to guess and give you wrong information. It's $1,000, dude. Pay it off and forget about it. I got 5 on it. Shoot me an email. I'll send you a $5 Venmo. Then you'll only owe $9.95. It'll feel easier. All right. I don't know when that started, but I'm just rolling with it. Feels right. I think it puts me in a better mood. You know what? it does put me in a better mood. And being live, interacting with folks, adding value, hopefully, that's helping my mood. I'm going to be honest with anybody listening. Today was not my best day. Today was a day full of struggle and frustration and things not going perfect. Gosh. For me and the whole team, to be completely honest, systems don't always work perfectly. Clients don't always behave perfectly. Real estate agents, gotta love them, don't always behave sweetly. So today tested us, but we got stronger because we made it through the storm. Oh, mercy. I'm just airing it out tonight. I feel like this can just be a big counseling session for Matt the Mortgage Guy. Kay Lewis, thank you for joining. How do I know how much interest is taken off my mortgage if I paid an extra payment this year? That's a good question. There's a bunch of calculators out there. A bunch of the servicers are starting to provide calculators wherever you sign on to make your payment that will say, make this extra payment. You'll shave 2 months off your loan and you'll save $3,622 in interest. That's probably your best bet as far as figuring out exactly what type of interest savings you're going to see. It's always a good thing, right? To pay a little extra principal and take off what you're going to pay in total interest. The thing that I would look at, Kay Lewis, which is kind of fun in my eyes, is let's say January, February, March payments. You can look at your statement and you made $1,000 payment to principal and interest. Then you got taxes and insurance separately. It should be broken down. Not all servicers are the same, so it looks different everywhere. But it might say $575 went to interest and $425 went to principal. So then your principal goes down by $425. And the next month, it might say $574 went to interest and $426 went to principal. Principal goes down by $426. What I would want to look at if I was you is how much that kind of accelerated that balance, right? Because as you pay more and more towards the loan, less and less towards interest and more towards principal on a monthly basis until you get to the end of the loan. And that $1,000 a month that you pay in principal and interest in the last year's, only $100's going towards interest, $900 towards principal. Rates are so low now, you'll take out a brand new loan, and even at the very onset, you're paying maybe $400 towards principal and $600 towards interest. But I'll tell you, when rates are at 5%, 6%, 7%, you're going to have $1,000 principal and interest payment, where $850, $875, $900 goes towards interest, and a small amount goes towards principal. So everybody who's under 4% interest rate should realize how amazing that is. Not just because your payment is less, but the rate at which you're paying off that loan, the curve is just a little bit sweeter the lower the rate. Get this cord out my way. I don't even need these things, right? If you guys say the sound is good, the headphones can just hang over there. I wear them when I'm doing Zoom and stuff because I'm easily distracted. I got to be in the zone with AutoZone. Zeta, I'm going to come back to you with what's new in the mortgage world. Not a lot. I think tomorrow FHFA will come out with the new loan limits, which I'm excited about. In California, almost all lenders have already gone to 625 as kind of like a base rate. And then county by county, you're seeing all the way up to 937, 500. But those new loan limits for 2022 are supposed to get announced tomorrow, I believe. places like San Francisco, LA County, Orange County, Santa Clara County, high cost counties, you'll be able to do a loan up to probably $950,000. Easy does it, headphones. $950,000 plus on a conventional loan, right? Not a jumbo. That's huge, huge. And then all areas of the country, it's going to be at least 625, maybe 630, 640, somewhere in there. So there's not really exciting news. I looked at Mortgage News Daily. I didn't see a lot of exciting stuff. Same old in the mortgage market. Rates are, better Friday, slightly worse today. That's one thing to remember, is that when there is uncertainty or negative things happening in news, like that Omicron variant or whatever they talked about on Friday, rates get better. Stock market tanks, rates get better. Market overreacted Friday. We saw quite a bit of betterment. It gave a little bit of it back today. All this up and down volatility in rates, day by day by day, it varies up and down, up and down. Over time, that's what it looks like. Worse. Up, down, 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 up, down. But the trend line, rates are going up. Like my dad would say, I'll bet you $1 and a hole in a donut. Rates go up next year. Jason Hibbert. What's up, man? Got your email. I'm on it for you. Let me take a look at that other thing we got going on. But random question. I can answer a random question. How do brokers and their staff get paid? All the time they put in helping everyone, do they only get paid from closings? Yes. Anybody who asks you to pay any amount of money, anytime, in advance, don't ever do that. Because the only way I ever get paid is after a loan closes. The lender to which I submit that loan pays me a percent of that loan as commission. Not paid by you, not paid by the seller if you're buying a house, not paid by anybody else. Paid by the lender who receives that loan. They're going to make money on servicing and all that other stuff on the back end. They pay me. I pay my staff. All the information, all the education, all the coaching, all that stuff up front, free 99. So it's just part of the game, and it's something that can be tough for a lot of folks, especially when you're first starting out. You could spend 30 hours with a specific client, coaching, educating, providing scenarios, answering questions, helping them get offer accepted, all that stuff. And then they go, you know what? This offer over here looks really good. I went with it. My mom's brother's sister's cousin told me about this online company. Thanks for all the help. Have a nice day. It sucks when you're new. When you've got a lot of business and you're more established, it's just kind of part of the deal. I try not to even pay it much. I've got folks that I talk to every day where doing it as much as I do it, I think I kind of get a feel for it. Where I'm like, they're not going to work with us. I provide value anyway. I answer their questions anyway. I can tell by the way they're asking questions. I can tell by some things they're saying. They're going to go chase the lowest looking interest rate, whether it's the best deal or not, right? I've almost given up on certain types of folks that are like, I saw somewhere that I can get a 2.75. And I'm telling them, listen, read the fine print, know what points you're paying, know that if you're in a purchase transaction using some random lender online that might not even close the deal is a little bit risky. With all that being said, I know certain people are going to do it anyway. They'll learn their lesson, stub their toe, and I'll get a call in 3 to 4 weeks when the thing's crumbling around them. But anyhow, how did I get so off track? Yes, only get paid from closings. Final answer. Oh, man. This is a good one, Mr. Buckaroo. That $15,000 first-time home buyers tax credit, a lot of talk around that when this current administration first got in to office. I know that it's important to Biden. I know it's important to the administration. I've talked about this, especially back when it was first being introduced, about how bad of an idea it would be. With that being said, on another podcast, when I was asked about it, I said, I don't think it'll pass in 2022. The person I was talking to thought for sure it gets passed in 2022. Here's what happens. Let's say you got a median home price of $300,000 in the area that you're in. You start giving incentives to first-time home buyers in a market that resembles anything like the market right now, where there's already way too much demand and not enough supply. You're putting fuel on that demand side. That $300,000 median home price will go up, I don't know, let's call it 15%. So now it's $345,000 to buy that same house, and you're getting a $15,000 tax credit. Who exactly did that help? When you paid $45,000 more for something and got a $15,000 credit. Certainly doesn't help the person getting the $15,000 credit. So not a good idea. I think there's other things that can be done. I think there's maybe incentives that can be put in place where you tell investors who own a lot of homes right now, if you sell to a first-time home buyer, if you sell to a buyer that makes less than X amount of dollars, if you sell to a buyer from a certain demographic, if you sell to a buyer who, has never owned a home or no one in their family has ever owned a home, some of the same verbiage that was put into this bill where they're like, these type of buyers are going to get an incentive. Instead, put the incentive on the sellers and say, if you sell to this person, you don't pay taxes on the sale, or, there's no capital gains up to X amount. I think that helps. Maybe. I don't know. There's a lot of different moving parts, and it's one of those things where it can't be done without some thought behind it and making sure that it doesn't negatively impact the folks it's designed to help, which happens a lot, more than it should. People in government need to listen to the boots on the ground sometimes that say, hey, hold up. Great idea. I know you're trying to help, but if you do that, unintended consequences might be this. I feel like that happens, and then they're like, we're going for it anyway. Looks good on my resume. It'll help me get reelected. And then unintended consequences hurt folks, and it's like, all right, Schmo already got reelected. On with it. So my 2 cents. And I'm not talking politics at all. I'm talking politicians in general, passing things that are only to put the gold star, only to get reelected, only to help themselves, not really the folks that they're pretending to help. Eric Alvarez, thank you for joining. What kind of condition does my house have to be in to refinance with a cash out? If you're doing a conventional loan and you're doing a cash out, it's got to be in livable condition. There can't be huge like health and safety issues like, a cracked foundation where the ceilings are falling or something of that nature. Similar type of stuff when you're buying a house. If you bought the house and used financing and it's in relatively similar condition to when you bought, you can assume that you can refinance and it's going to be fine for conventional financing. But yeah, that's across different types of loans. It's fairly similar, but conventional loans that are the most common, the roof's got to have 2 years of usable life. It can't have a cracked foundation. You got to have running water. A lot of places you got to have heat and air conditioning. So just the basics. No problem, Evan. Happy to help. Colleen Johnson, thanks for joining. Uh-oh, did I freeze up? It's froze up. Is that on my side or your side? All right, back to Colleen. When an investor refinances a primary home, will the investment property info have to be provided? Yes. If you're doing a conventional refinance, a conventional loan of any type, income information, asset information, including like all properties owned, those mortgage statements, homeowners insurance policies, what they rent for, tax returns, all that has to be provided because it all goes into that debt to income ratio that says whether or not you qualify. So if you own 4 homes and you're trying to refinance your primary, we're going to ask for statements from your investment properties. We're going to ask for tax returns, which show, rental income from those properties and all the things around your finances. I'm pretty sure that was what was being asked. Jason Hibbert. Have you ever seen someone with under 10 years left on their mortgage refinance? I have. Everybody's different. So everybody's got different goals and needs and whatnot. I try not to impose any of my personal opinions or beliefs on folks. I present options and then talk them through. What are you trying to accomplish and how can I help you accomplish that? For some people, get this house paid off before I retire. I want to retire with no mortgage payment. Okay, let's see how we can accomplish that. For some people, goals are different. And, to speak to your specific question, I've had people that are 4 years from paying their house off or 6 years from paying their house off. They read something new, saw something new, talked to new people and said, man, I've got $400,000 in equity sitting here. I can pull 200 of that out. I can go buy something cash that's going to kick off $1,200 a month. And that 200 I took out, I'm only paying $800 a month on that. Whatever those numbers work out to be, right? Folks do it all the time. And it's not as dramatic as people make it out to be because the average debt on a home is like less than 60% in aggregate. But plenty of people are cashing out all over California, where I do a majority of my business. People are sitting on mounds and mounds of equity. And I say that I don't inject my personal beliefs on folks when I'm talking them through a refinance, but I will tell you my personal beliefs. If you have a good use and a little bit of tolerance for risk, good use for the money, and, a little bit of tolerance for risk, pulling money out of a home and investing it and getting 6, 8, 10% returns while you pay 3 or 3.5% on the mortgage sounds like a good use of leverage to me. Some people know, some people will think that I'm a nut job, but tons and tons of smart people are doing just that. Leveraging. And here's the thing, you don't over leverage, right? You don't go to 80% loan to value on your primary and 75 on all your investments and just go crazy with it. Some folks have a ton of equity and they can pull cash out and stay at 60%, stay at 70%, stay at 75%, and comfortable mortgage payment, be able to go out and invest. So I don't know, to each their own with that. Colleen Johnson. This is a good question because I think you've probably heard we're in 43 or 44 states as of today. I know that Texas is one that's hard to get, don't have it yet. I'm sorry, we have it in Texas. Rewind. No Nevada, no New York. There's a handful. It's like 5 or 6. We're in 44 of the 50. So ping us. Here's what you got to do. Go to greatmortgagebroker.com. If we're not licensed in that state and you're like, hey, I want to get a loan in Nevada, just like I did today, I'm going to say the number one broker in Nevada, absolute rock star, Elena Boland and her team, able to take good care of you. We're going to point you in that direction. So reach out to us regardless. If we can't lend in that state, we'll point you to somebody who can. Not just somebody, the best body. Look at this guy, my buddy Kyle Seagraves. Where are the 2022 loan limits? I was waiting, bro, because I'm telling you, tomorrow when they come out, I'm going to be just like every other lender out there. I'm going to blast out 2022 loan limits are here. You know what I'm actually going to do? I'm going to try to do it with my boys. I think we have a tradition. I think the last couple of years when the new loan limits come out, the video is with me and my boys. I saw a flashback from last year and maybe the year before where I have them in the videos with me. So I think they're coming out tomorrow, right? Put your guesses in for conventional loan limit. And this is nationwide. There's different limits. There's like county limits where the high balance goes, like we've seen in, San Francisco, San Mateo, Orange County, LA County, 822, 375. We know it's going to be at least 937, 500. But let's take guesses. Lenders have already said we're good up to 625,000. They're raising that current 548, 250 to 625. Over the last month, they've done that. But the numbers coming out tomorrow, 548, 250. I want you to guess, Kyle, because you've got a good finger on the pulse. I'm going to put my guess in the comments. I think they live here on YouTube forever. But loan limit for 2022, conventional nationwide loan limit. Here it goes. 2022 prediction. If somebody nails it, I'll send you a sweet care package. So I'd like to see some guesses. Here's mine. $646,935. It's my guess, and I'm sticking to it. If I hit that right on the dot, Kyle, you're coming on next Monday as a guest, and I get to pick what shirt you wear. You gotta guess. You gotta guess like a number. I mean, it could be exactly 650, not likely. You got to get fancy like me, bro. You got to be like 646,935. So put your guesses in the comments. Big prize up for grabs. I'll just pack a swag box with T-shirts, Yeti mugs, the bean bags that hold the cell phones, all the swag, all the Matt the Mortgage Guy swag, and more to come. To the person who's the closest. All right. NW Coast Local. What requirements for no doc loans? 800 plus credit score plus savings. When you say no doc, I'm assuming you're talking about debt service coverage ratio loans or some sort of bank statement loans. They're certainly not that tight that you got to have an 800 plus credit score. But as a rule of thumb, they're going to require larger down payments. I've seen some where you can do 15% down. Most of them are 20%. I think some of the more aggressive lenders might allow you to go down to like 660, but others are going to be 680 to 700. There's really so many of those out there that it's hard to pin down a specific requirement. But I would just go in with the assumption you're going to put 20+% down. You're going to have decent credit. No one's going to require 800, but some might want 680 plus. Ace. Can I sell my house to a parent and still live there? Sure. The lender can't tell you you're not allowed to live there. It's a house you own. You're going to sell it to your parents, and then you're going to stay living there. I don't see an issue with that. K. Lewis. What type of exemptions are available when we take care of our elderly parents? Looking to keep taxes low. I think this is a tax question. I better not try to answer it. I'm not a very good tax advisor. I mean, half decent mortgage advisor. Taxes, I try to stay away. What's up, Al Bundy? Oh, this is a good one. Is it as important to not use a big online lender when refinancing as when buying? This is a good question. I'm going to try to answer it as honest as I possibly can. Because like I said earlier, when you're in the process of buying, you've got a closing timeline, 25 days, 30 days, whatever the contract says. You've got loan contingency, you've got appraisal contingency, you've got a bunch of things, dominoes that need to fall into place. There's not a lot of room for error. The last thing you want, one of these big online lenders, is not being able to get a hold of somebody, not being able to close on time. The one I see so often, I'm literally taking an application today, me and my team, for a friend who was using Quicken. I won't name the lender, but Quicken. And issued a pre-approval letter. Said, you guys are good to go. They're 2 weeks in and they're like, oh, you know what? We can't get the loan done. Frustrates me to no end. I told them, let's get the application. Let's take a look. If we can't do the loan, I'm going to tell you within 24 hours. I'm not going to have you in contract 2 weeks in, appraisal paid for, inspections paid for, then turn your life upside down being like, no, we can't do it. Oh, so that is humongous issue with using some, took everything in me to not use any profound language. But here's a good point, Al. You're like, okay, it's risky. I don't want to risk it when I'm in contract to buy. What about refinancing? While you won't have all those same time pressures, the issue with refinancing, from what I've seen, I'm just speaking what I've seen because I literally listen to stories all day, every day. All I do is talk to consumers. Someone goes out shopping and they're looking for the very best rate. They might get a great rate and tons of fees and just look past the fees. Consumers are really good at not understanding, but telling themselves in their head like, oh, 2.75, cool. And then I'm like, you didn't notice the $8,600 in points? It's the worst looking deal I've ever seen in my life. Side by side versus a 299 with less fees, it's not even close. The 299 is light years better. But a consumer's like, 275 seems legit. Go for it. That's one problem. Another problem is, especially right now, more than ever right now, lenders are aggressively going after business. You know what I did? This was over the weekend. Come on, camera, focus. There we go. One, I blacked out. Two, three. I went and got mail at a house I own. A 2.5% fixed, by the way. So I thought this one was funny. No closing cost refinance. They're offering me 2.95. Well, sweet. I got a 2.5%. Holler at your boy. But mortgage companies are getting more and more aggressive. They've got a bunch of staff. Refinances have started to wane because rates have gone up a little bit. They're going to lie, cheat, and steal to get your business. That's the honest truth. And so it's important as well, Al, to not use some big company that's great at marketing but shitty at loans, because I know for a fact, 100%, some of these operations are like a boiler room, right? smile and dial all day long. You don't have to know anything about loans. If you can get the person apped up, application in, you get a spiff, $25 every time you get somebody apped up. Then that salesperson that gets the app, if they can get it to closing, they're going to get $50 per one they put into process. Maybe it's like them putting it into process, and then the process gets a spiff, or they get a bonus for getting it to the finish line. But they're all just working off sales incentives. Nothing to do with like, what type of client experience did this person have? Did you set someone up with the best loan based on their goals, their scenario, their specific? None of that, right? That's a big problem. And for somebody who has built a business and built a team around serving consumers at a high level, I couldn't get more passionate about wanting all of those businesses to fail. They're not in it for the consumer. All right, rant over. Timothy Leonard just refinanced to a lower rate in April. I'm now looking to a cash out for a decent amount. Does it make sense since I just did a rate refinance recently? I think it depends on what you're going to do with the money, what your current rate is, and what the cash out rate's going to be. If you let's say you refinance in April to 2.75, and now you're looking at like a cash out refinance at 3.125, and you're going to pull, he says decent amount, so $75,000 in cash out. You've got to make sure that whatever that $75,000 does, I'm all for deploying capital and making returns and investing. I like that stuff. I'm in growth mode. I love me some leverage. But you got to realize that whatever you owe currently, plus the new amount borrowed, all of that is going to be paid back at a higher interest rate. So it's got to be worthwhile. And I think you want to talk through that with somebody who's going to give you straight answers. I think you want to look at it and say, $1,250 a month right now, $1,650 a month with the cash out. What am I going to do with that money? Is it going to create $800 a month in cash flow for me, and this new loan I have cost me $400 a month more? Maybe that's worth it. Is it going to provide, $400,000 in increased net worth 10 years from now? And is it worth it in that way? Those type of questions, I think, is what you want to ask. Colleen Johnson. The rate difference between refinance primary and investment property, about 0.5%. It's a for some scenarios, I think you're probably looking at like 3.125 on a primary and 3.625 on an investment. Maybe even, 60% LTV versus 75% LTV, 800 credit score, 720 credit score. There's variables, right? But 0.5 to 0.75 difference between primary and investment. That's where I'll probably just slap my guesstimate. How do you pin? See, this is where I need to get better. Kay Lewis, I'm working on this for you to pin the website, greatmortgagebroker.com. How the heck do I do that? Let me take a look. Oh my gosh, there's a lot of questions. How did I get so far behind? There's how you pin. Okay. Where'd I put my own comment? Let me do this. Great I'm going to do that. You're talking about the Great Mortgage Broker one? This is how you connect with my team, and they will get you rolling in the right direction. Paste. There we go. See if I can do this. Pin message. I think I did it. Thank you. Thank you, Kay Lewis. I learned something new today if that worked. Click the 3 dots. There you go. See? Kyle's the pro, man. Get on here, Kyle. Give me some assistance. Al. Oh, you know what, Al? Oh yeah, this is the question too. Rate difference between FHA and conventional. Why would a buyer with great credit score use an FHA loan to buy? Usually not going to. I mean, right now it's going to be, I'm not seeing a lot of FHA. I mean, I'm seeing next to no FHA. I haven't priced an FHA loan in a long time, Al. That's how much I'm not doing FHA. But for you, let's do it. Let's price a 3.5% down FHA. The debt to income ratios are higher, so maybe, just maybe, you're like, I really got to buy for 520, and I'm only qualified for 490 conventional. The problem with where I'm at is it's going to be really hard to get something accepted FHA if there's conventional offers on the table. So, so that's where I think it's just probably not very likely. But I'm going to price this for you, Al, just so that we can see it on where it would land. Say you got good credit, $500,000 purchase, 3.5% down. We'll look at that 3% down conventional versus 3.5% down FHA. And my guess is 0.625, 0.75 lower on FHA. All right. Conventional's got $132 a month mortgage insurance. And rate's about 3.25 without paying any points, otherwise known as 3.25. The mortgage insurance on FHA is $338. How you like them apples? That's where, like, with a good credit score, FHA is going to be nasty compared to conventional. Granted, the rate is like 2.5, right? So the rate's 3/4 better. 2.5 without paying points, and all-in payment with mortgage insurance $22.77, and then 3.25 conventional with that lower MI is $22.32. So side by side, conventional's $45 cheaper. $33.77, yeah. $45 cheaper. Even 3.25 versus 2.5. And the MI on conventional falls off. FHA, you got to refinance it off. I don't think you would. The only reason is if, like, that unique scenario where the 50% or 53% DTI works FHA and it doesn't work conventional. I'd find a way to make it work conventional. I don't think it'd be a good long-term thing for the person with 800 credit score to go FHA. All right. This is not a serious guess, Kyle. This is a very serious Q&A, okay? Just kidding, brother. 832, 375. I'm looking at Al's high balance guess. You're going to be close, Al. 975, I did some quick math because I'm expecting like somewhere between 15 and 18% increase. And that's like a 17% increase from the 822, 375 to your 975 for high balance. So you might be right. Basilio, thanks for joining. Appreciate you. I did have a great holiday weekend. Thank you. Chill time. Small little family event. My side and my wifey's side. Thanksgiving Day. It was chill. And I got Christmas lights put up yesterday, which makes the wife happy. And as you all know, happy wife, happy life. Christmas time is pretty magic, especially with the kiddos. All right, Corbin, 6 1/4, 654. Bruno, I like this, bro. I think this is going to be it's going to be close. All right, Basilio. Whatever follows this question, I'm scared for you already. Is my credit about to get impacted? I forgot to set up edit auto pay on one of my mortgages, so my payment that was due on the 1st is being paid tomorrow. Okay, make sure you pay it tomorrow. If you pay it tomorrow and you don't have a 30-day late, you're good. You're going to pay most all mortgage companies. If you pay after the 15th, it's late. They might charge you 3%, 5%, whatever the heck they charge you, $142. That will be nothing compared to the impact on your credit score if you paid it on December 1st or December 2nd. So make sure it gets paid tomorrow. Make sure there's no 30-day late. I'm guessing wherever you're at, it's too late for you to be on the horn today. But yeah, get that thing paid. Make sure it doesn't report late. Oh, I hurt for you, man. That sucks. I think you'll be all right, though. I got faith. Yeah, I mean, I can't imagine they've already reported it. So I would make sure it's paid and then talk to somebody and get them to tell you over the phone, yes, I see your payment. It's posted. No 30-day late is going to be reported in our system. You're good. Zero balance due. I would have them repeat it, and I call back and I have somebody else repeat it because it's that important. Yeah, I'm with you, man. I wouldn't be able to sleep well either. I mean, I'd pay that thing freaking twice. Yes, sir. Good benefit in working with somebody like Kyle Seagraves or Matt, the mortgage guy, is that we're going to help strategize. Do you need 60,000 cash out or do you only need 35? Are you staying in the house for 3 years or are you staying in it for 10? Do you want to pay points or do you not want to pay points? Do you want to take a rebate, take a higher rate because you're going to sell in 24 months, but you want to pay off a bunch of debt and structure things and get yourself set up. Lots of different moving parts. Not all mortgages are created equal. And what do they say? Failing to plan is planning to fail. I see a lot of ugly mortgages fund. And some of them I save. Some of them people reach out to me and go, hey, can you take a look at this? And I look at it and I go, what in the world is this? $9,700 worth of fees to save $32 a month? Don't ever do this loan. Well, they told me this and they told me that. And they said that I would, get a refund of my escrow account and I'd skip a month. And that, because my rate is doing that, they're talking you in circles because they're trying to get a commission by closing a loan. Talk to a professional that's able to give you good advice. The best professionals in mortgage are looking out for your best interest because my business depends on client satisfaction and client experience. That's how I get referrals. That's how my business grows. I don't try to jam as much stuff in so I could have the biggest November of all time or the biggest December of all time. I'm trying to do everything I can to serve clients at a high level so I have an amazing 2025. So me and my staff can celebrate, record-breaking months in 2028. 2032 is going to be an amazing year. I'm not worried about December of 2021. I'm just adding value and helping folks. The rest won't happen. There you go. Press that thumbs up. Where are we at? 12. One day I'm going to be like Win the House You Love. Be crushing it with hundreds of likes. I'm just a small fry. flying under the radar. 660, 668. You took like the under on Kyle's guess. There you go. I have the same answer. What do you know? Yeah, I'm rooting for you. I'm rooting for you, Basilio, because we do not want to see a mortgage late. That's Megan Lenoir. Lenoir? I don't know. 780 versus 800, no difference. Most lenders, you're going to be in the same bucket, 760 plus. Some lenders might have, a loan level price adjustment between 780 and 800. I do not think so, but putting 25% down, you only a sweet rate, and you're not going to see a difference. I mean, you've got the best credit, for purchase. 25% down is a better rate than 20%. The only other tier where you see a little bit of a difference is when you go to 40%, but 25 and 40 is so minute that I wouldn't worry about that 15. You're going to get great terms putting 25% down. And 30-year fixed rate money near 3% is winning. So you're winning. I'm not even going to try to pronounce names tonight. I don't feel like my pronunciation game is on point today. Tanisi Adams? That's got to be it. What are some criteria a new first-time investor should have as part of their buy box? We're trying to pull the trigger on purchasing our first property. Great question. Where you want to live, where you want to be as an investor, live was probably not the right word. Where you want to be is somewhere between analyzing like crazy and just taking action, right? This is what I see from a lot of folks. Some people are like, I want to be an investor, buy. No thought at all put into it. And I see other people that have been talking to me for 5 years about buying an investment property. They've analyzed every single thing. They know how many blades of grass are on the average single family in the county they're looking in. That's not where you want to be either. You want to be somewhere in between where you want to have a really clear idea of what it's going to rent for, what the expenses are going to be, what the mortgage is going to look like, the debt service. And then you want to look at like your long-term goals. I think sometimes too, people they don't understand their end goal, how they can make a decision on a property. Because for some people, myself probably included, I don't need cash flow. I don't need to look at the homes that cash flow the best. I can look at stable investments that are going to increase in value over time. I'm going to win with the appreciation game, with the debt pay down game. And so controlling a more expensive asset that's going to appreciate more, and that I'm going to see, more wealth accumulation through debt pay down is going to do me better than buying cheaper assets with better cash on cash returns that are going to provide cash flow. Because, if I add $400 or $600 a month cash flow, it's, I'm not living paycheck to paycheck. I'm not trying to get out of the rat race and, get to $3,000 a month so I can play video games and have my bills covered. It's not the game I'm playing. Some people, maybe that is. And so get really clear on what your goals are. Then with that, run numbers to figure out how you're going to accomplish that goal. If it's an appreciation thing, you look at who's moving to this area, what the future appreciation might look like, what the loan is going to look like. Like my buddy Mike Zuber would say, never buy an alligator. Some people don't even know what an alligator is, but if you do some math and you say, oh, great, this thing's going to have a $2,100 a month mortgage payment. I can rent it for $2,200. I'm good. Not taking into account expenses that might come up. And all of a sudden, the thing's losing $200 a month, losing $300 a month. That's the kind of stuff you want to avoid. So hopefully that helps. I feel like I put out a video on this at one time or another. Thank you very much for the super chat. Oh, look at that. Helpful AF, as always. I appreciate the kind words. I mean, that's what I'm shooting for, is helpful AF. That's what I should put that tagline somewhere. One last thing. I think the two ends that I talked about, like take action with no thought and overanalyze to death, I'd rather be closer to the take action with no thought. Truth be told, I bought some straight lemons in Alabama, and I'm not sad about it. I'm glad I learned those lessons. I sold and lost money. Who cares, right? I took action. I learned stuff. I made better investment decisions on the ones going forward. Don't make a decision that can kill your dream before it starts or that can bankrupt you. But if you buy your first place and you get 9% cash on cash returns, or you get 6% cash on cash returns, that's not going to matter as much as one deal under the belt, realizing like, oh shit, I can do this. This is not as hard as I thought. Then you go out and buy the next one. Then you go out and buy the next one. You get better and better at the analysis, and you realize like, oh, you know what? I just realized that in this part of town, I can get this much rent. I know what the loan looks like. I know the loan process better. You just get more comfortable in all the parts of it. You get better, just like you would with anything else. The more basketball you play, the better you're going to get at basketball. The end. Oh, we answered that one. Colleen Johnson, how many loans can you refinance at the same time for one person? 10. 10 would be tough. But you could. I mean, I've had plenty of 4-packs and 5-packs where I'm doing a collection of refinances for the same person at the same time. Truth be told, all the stuff you're supplying, your W-2s, your pay stubs, the homeowner's insurance statements, the mortgage statements, all that. If you do one loan now, one loan in 2 months from now, one loan 4 months from now, you're going to be providing all the updated documents over and over and over and over and over again. You might as well just do it all at once, right? So yeah, 10 is the limit that Fannie and Freddie will allow you to have. So I couldn't imagine you doing more than 10. 10 investments, one primary. There's a little exception. So yeah, that's the best answer I got. Al Bundy. Tap the like button, friends. If you like Married with Children, hit the darn like button. What can someone answer me the question? Like, they did away with counting the dislikes? Why? Some videos are crap. Some of my videos might be. Well, some of my videos are crap. You should be able to see like 80 dislikes. Maybe YouTube should take the ones with the most dislikes and take them off. I wonder what why am I trying to figure out why? Why ask why? Has something to do with money. How do you reason if buying a point is worth it? One $13,000 point can drop my rate to 2.125. A point is 1% of the loan amount. And so if you're saying one $13,000 point, it's got to be a $1.3 million loan. I wouldn't think that 1 point is going to drop you that low. So maybe it's a $260,000 loan. It's really 5 points to get you that low. Here's what you got to take into account. If you're paying $13,000 to lower the rate to 2.125, let's do a real life example. I like real life. Since I said $260,000, I'm going to stick with it. $260,000 loan. I'm going to pretend that, where is it at? There it is. Pretend that like 299 is the rate for 0 points. And then 2.125. Funny, it's about 5 points. So yeah, that's about 14,000-ish. The payment difference, 299 on this $260,000 loan, 1096, and then you go down to 2.125, and this is where I wish I had Kyle's like drawing. 977. Is that right? Yeah, 977. $119. You guys following? You're going from 299 to 2.125. You're saving $119. If you pay $13,000 for that to save 119, it's going to take you 109 months to break even. I would never, ever, 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 ever do that. Pay $13,000 to save $119 a month. One, you might not be in the loan for that long. Two, $119 9 years from now doesn't have nearly the same power that it's got today. Today's dollars are more valuable than next year's dollars, much more valuable than 9 years from now dollars. Paying a bunch up front to save money on a monthly basis, like anything more than a 3-year break even, is rarely recommended, except for extreme scenarios where someone's going to stay in the house forever. They're on a fixed income. And they're like, listen, this is my feet first house. I'm going to stay here forever. I want a payment under $1,000. I need to do that. I got money now. I'm willing to pay. I just need a payment under $1,000. It'll help me live comfortably. All right, cool. All right, Jim Beam. I'm closing next week remotely, 1,500 miles from the title company. How do these signings usually take place? They've got mobile notaries all over the country. I've got people that are signing at the U.S. Embassy in China. I've got people that are signing at the U.S. Embassy in places around the world. A mobile notary will get to you, whether you're in Nantucket or San Diego. You'll sign. They'll overnight FedEx those docs to the title company. Title company will receive them just as if you signed in their office. Truth be told, most title companies are doing remote signings and not having people come in their office. So even if you were in the same town as your title company, they'd probably send a mobile notary to you at your home or at Starbucks or something like that. So no big deal. Stuff. It's super, super common. My buddy Jason Hibbert, can you consolidate other debts into your mortgage? You can with a cash out refinance. That's essentially how it's done. If you owe $300 and your house is worth $500, lenders will allow you to go up to 80% loan to value. So you can go up to a $400,000 loan, take that $100,000, pay off your car, pay off your student loan, pay off all your debts. You're essentially consolidating it, right? Now you owe $400,000 to the mortgage company. All those other debts are paid off. As long as you qualify and the debt to income ratio stuff pencils, sure, you can consolidate. I mean, it makes sense for a lot of people right now who are equity rich. If you've got $60,000 and 16% credit card debt and a ton of equity in your house, you want to take a look at a debt consolidation refi. That's something that's going to be super prevalent in 2022. It's going to be something that helps a lot of people, but it's also something that you don't want to just willy-nilly. Talk to a pro that can help you structure it correctly. A loan structured incorrectly can have a negative effect, or at least it's not as good as, a well-structured loan with a mortgage professional. The end. Unique one. $670 score, $3,000 in credit card debt. Should I pay it off to get a better rate with the VA? VA loans, you're going to get a smoking rate. I think I would probably talk to a mortgage pro to see. I mean, the 670 score might be due to other factors, right? Paying off that debt might not necessarily improve your score. Let me take a look-see here. Because what might happen is you might do a pay off that debt, rescore your score, it gets to 695. 695 and 670, the rate might be very similar. I'm pricing it real quick, just out of my own curiosity. My guess is that between 670 and 699, you're not going to see that much of a difference. So I mean, debt load is part of the credit score, but not all of it. So depending on how much it's going to help you, man, VA rates are smoking. Even at 670, you can get a 2.5 without paying any points. Nice. Okay, so let's see what happens if you go to 700, which you may not be able to, right? It might not be going up 30 points. Come on. All right, so you got that 670, you're about 2.5. 700, let's see if you get better. Talk to a local mortgage broker, by the way. VA rates vary more than any other rates I see, where somebody's like 2.875. 700 and 670, same exact rate. I don't think you got to pay off that credit card debt. Yep, same rate. All right. Dr. Delroy Fredericks, thanks for joining. I know the banks require 2 months bank statements for pre-approval, qualification money in the account. What if the money has only been in the account 1 month? Would the bank still do it? If it's been the bank for 1 month, they're going to ask for where it came from before it landed in the bank, right? So you got a deposit that just landed on October 25th. You're going to have to source that somehow. You need 2 months of history. If it came from a cash deposit, no can use. If it came from something, like an investment account, you can use it. You just got to show the 2 months of that investment account as well. Do they still allow you to get cash back at closing if your approved loan amount is greater than the purchase price? No. You could buy a house for $700,000. It can appraise at $1 million. You can't realize any of that equity or say like, oh, no, I want to borrow $800. Give me $100 in cash. I want to fix up the kitchen. It's a good question. I've heard that question before, but no. Right. A higher appraisal doesn't allow you to borrow any cash at closing. Can I apply for and use home equity line of credit as down payment on a new house around the same time I'm looking to get a new mortgage? Would that affect my home buying process? If you pulled home equity line of credit from your primary and wanted to use it to buy an investment property, for sure you can do it. If you pulled a home equity line of credit and then we're trying to buy a new primary, you might have an issue with that. Just because that home equity line of credit is usually for a primary. It's a good question. Maybe you could use it and we could just factor in the payment on the home equity line of credit. All right, HELOC. I'm going to put this in my notes. HELOC current buy forward. It doesn't feel right, but I'll double check. Theo B. As you buy more properties, the reserve requirements increase. Is there a way to go around that? Well, if anybody doesn't know what Theo is talking about when he talks about reserve requirements, let's say you own 2 rental properties and you've got a primary, you're going to buy a new rental property. The lender is going to require you to have a certain number of months of reserves. Reserves are money in the bank, reserve funds, really to make them feel okay about what if something goes wrong with one of these investments. And when it's a number of months of reserves, it's meaning this property has a $1,500 a month payment. This one's got a $2,000 a month payment. If they want 3 months of reserves on each, they want $4,500 for the $1,500 a month property. They want $6,000 for the $2,000 a month property. And that's really to protect. You should have reserves in general to protect yourself, right? In case renters leave, there's damages, you got to do repairs. And so the lender wants to know that you're in a good financial position should something go wrong. Is there a way to get around that, Theo? Unfortunately, not. Like the Fannie Freddie guidelines, conventional guidelines are going to say reserves are needed when you're buying an investment property, when you own other investment properties. That's the short answer is no. You got to have them and you should have them. Jim Bean, my loan officer told me that my points would cost $88 on my $78,000 loan, but he did not tell me how many points I would be allowed to buy. How many points are usually offered to the buyer? Now, to be clear, $78,000 loan, 1 point. Man, I thought I was going crazy for a second. 1 point is $780. It's 1% of the loan amount. That's what a point means. He might have meant that like on your loan, there was only $88 in points, which was like, 0.12 of 1 point. $780 is a point. And I'll show you, let me show you a little something. This should help. On every single loan, in the world, with every single lender, there is going to be a rate sheet, meaning pay points, rate goes lower, get points as rebate, rate goes higher. And so it's not like, oh, Jim, you've got 3 points available. Somebody else has a different number of points available. It's just going to be a rate sheet. And here's what it's going to look like. Can I zoom in? I'm going to make sure that you guys can actually see this. Come on. I'm going to try to zoom. Oh, mercy. Okay, this should be good. Now, let me pull this bad boy up here. Share screen. Now take a look-see-loo here. This is the rate sheet. I zoomed in. I'm not sure if you can see it, but let me take this puppy off of here. Take that off of there. Can you guys see all the way to the bottom there? Hopefully you can. So 3.125, 0.018, $72 to buy the 3.125. 0.4 is 0.4 points to get to 3%. 1.029, that's about 1 point to get to 2.875. I've talked about this too, like the law of diminishing returns. Almost 2.5 points to get to 2.6. More than 3 points to get to 2.5. You would never go all the way down here. You would never buy it down to 2.25 and pay $20,000 in points. But you might be in a scenario where, like, you know what? I'm going to take the 3.375. I'm going to get $4,600 in lender credit for that rate, right? Because it's a negative number, a point in a rebate, they call it. Take 3.375. The par rate, meaning 0 points, for all intents and purposes, this is the par rate, $72. Between friends, what's $72? And so this is what it's going to look like. All this is available to you. You could spend 4.956 points, 20 grand. This is like a $400,000 loan. You would not do that ever. But that's what it's going to look like as far as like how many points am I able to buy. Hopefully that helped clarify a little bit. All right, where are we at? I like all the comments. I appreciate all this interaction. You guys are the best. David Forrest, I bought my first rental property all cash. I don't have a W-2 job. I want to leverage the property. What do you suggest is a better way to leverage the house, home equity, or refinance? You could refinance and do a debt service coverage ratio loan. Rates are going to be higher, probably 4.75-ish. But if it rents for $2,000, you'll be able to do a cash out refinance, keeping the mortgage payment under $2,000, including tax and insurance. And it's relatively easy loan to do. Debt service coverage ratio loan is the loan that you're going to have to get. You know, you can't get conventional financing without any income. All right, Tim. I currently have a mortgage of $325. My house is worth $570. I'm looking to refinance, but I have a car loan of $19,000 and a personal loan of $25,000. Should I refinance the house, pay off my car loan and personal loan, or should I refinance and put my equity and investment into an investment property? This is a good question, Tim, and this is all on you. I mean, you've got to tell me, what are the goals? Do you feel good about having no debts? Do you want to build real estate portfolio that spits off some cash and you'll have them paid off in X number of years and be able to retire off of that income? Depending on what the goals are, it's going to probably lead you in different directions. There might be a combination of the two, right? If your house is worth $570 and you do a cash out refinance to 80%, that's a $456 loan amount, and you owe $325. Let's say there's some costs involved. Let's say $120,000 cash back to you. You could pay those off, still have 75 grand, and maybe go buy an investment property for 300 with 20% down. You know, it might be both. And depending on the rates on those car loan and personal loan, maybe you take the cash, buy the investment property kicks off $600 a month. You use that $600 to start accelerating how you're paying those things off. And that's a better strategy. It really depends on you and your goals more than anything. You also, when looking at all of this, make sure, above all else, in my opinion, you look at the new loan on your primary, and let's say you do the cash out to 456. Don't do it if that new payment is something that puts undue pressure on you, stress. If you go from a $2,200 a month to $2,700, and you're like, man, like that one is gonna be stressful on me, then I would avoid. So if the goal is build a portfolio, and this personal loan and this car loan aren't high interest, I personally, I might get flamed for this. I would buy the investment property, use some of that, cash flow that you're going to get from the property to pay off those other debts, and do that after. My 2 cents. What's up, Mr. Mark McDonough? I was silently creeping on you, bro. I was listening to your live stream before I got on here. Mark is Mondays at 5:30. He sneaks on before me. I mentioned earlier, Mark, that I might start doing 4 o'clock because there's some Kings games on Monday nights, and I like the pain. So I still have season tickets to the Kings because I like to just feel the pain of going and watching them lose all the time. So we might flip flop. Might be you. It's you than me right now. It might be me than you in the future. But I'll be sure I'm a way out at 5:30 to direct them your way. Counter offer just sent in. Me and Mark have some mutual clients, and as much business as he does in Sacramento, as much business me and my team do, it was inevitable that we're going to cross paths and have a client that came to him and said they wanted to look at a house and put in an offer, and then he's asked them, are they pre-approved? They said, yeah, with Matt the mortgage guy. He said, I think I know that guy. So cool beans, man. I like our chances. I like our chances because a good agent and lending team are not just sending in offers and crossing their fingers. We're talking to the list side. We're strategizing with the client. We're working together, having conversations around how to help the client put their best foot forward. And not just that, I'm talking to the client and saying, if this, then that. If it appraises at this, if you offer this, if the appraisal comes in here, if you waive the appraisal contingency, here's how it's going to affect you and your loan. Okay, client says, I feel comfortable. Mark, I'm comfortable to write this number, that number. And inevitably, I like our chances, Mark. I think fingers and toes, man. I root for all my clients. Some clients more than others, to be honest. I like this client of ours. Good folks. I'm rooting for them. Let's do it. God, I'm fired up tonight. Chisel, good advice for Tim. You want the rate of return greater than the rate on your debt. True. Yeah, see, those 3% and 6% aren't that high, right? Go buy some real estate that's giving you 8% return and then pay those off with cash flow or down the road. All right, Sophie, I didn't forget you. I'm coming back to you. If I move my house to a trust, what is the chance that in case rates will come up, let's say 5% or more, the bank will ask to return the loan or line of today's rate? The chances that happens are next to zero. I've got houses in trust. I've got houses in LLC. I've helped a bazillion clients close loans, transfer it into a trust, transfer it into LLC. If you are the owner of the trust, you sign on a loan, you personally guarantee it, and your name's on the loan. You transfer it to a trust that you're also owner of. That's not going to trigger that due on sale clause. Transferring it to an LLC where you're an owner and you're also the person signing a loan, I've never seen it trigger that due on sale clause. Is that what it's called, due on sale? Is there a calculator see today's rates with calculation of the lender credits? It changes every single day. So I don't think there's like anywhere. Where did I see that? Like current rates. Today's mortgage rates. I don't think it was Mortgage News Daily, was it? Oh, there's a daily mortgage rate survey. Let's see if you click on it, if it gives you anything. It just tells you like the average rate on a 30-year, 3.21. Average rate on a 15-year, 2.6. And this is oh yeah, so there's like a Freddie Mac and an MBA. I'll show you guys this. I like Mortgage News Daily, so I'm gonna share this screen with you. Boom. If you go to Mortgage News Daily, here's what you do. Mortgage News Daily, great website. And then you go over here to the right, Market Snapshot, Daily Mortgage Rate Survey. It's like a survey, right? Where they're like, what's the average 30-year, 15-year, FHA, Jumbo, 5/1 ARM? Click on View More Mortgage Rates. And it's going to show you like how they got that number, their rate survey, what it was yesterday, what the change was. And then down here is important because it's like the MBA 30-year fixed is 299, but it cost 0.3 points. And then Freddie Mac said the 30-year fixed is 3.1, it cost 0.7 points. And that's just different lenders. Compare rates from different lenders. Oh gosh. Don't do this. Oh, this is where, look at that, 4.25, sweet rate. What in the friggin' world is going on? But this is also like district lending, whoever this is, help your soul if you try to go with simplest or district lending. Like, you just never make it to the finish line. Loan Depot's a reputable company, right? They're 3.25. This is about where rates are without paying points. And then, you know, I don't know. These other lenders, I just, buyer beware. Oh, look, sponsored. All kinds of problems. Too many horror stories to share in one friggin' episode here. Just high quality broker you like and trust with a competitive rate is what you're looking for. You go shopping for the best rate, you're going to find the biggest liar. And you're going to find yourself in a lot of pain. What if you went out and you're just like, I'm just going to find the cheapest car? Cheapest car I can find. That probably wouldn't work out too well. Get to bed, bro. This guy just powered through alive even though he's sick. Let me know when you hear the good news. All right, a couple more questions and I'm logging off too. I've had enough fun for the day. Colleen Johnson, which one will you use to qualify? Current lease or appraisals adjacent house rent? When you're refinancing an investment property, saw the subsequent comments, you can do the appraisal and then the rent survey as part of the appraisal. So the lender's going to see what the area rents are. Can use either. The current lease, it's just the current lease can't be way out of line, right? If the rents in the neighborhood are $750 a month and your lease says $1,900 a month, lender's going to say, I don't think so. But if it's reasonable, can use either. Yep. All right. I think that's it. Any last questions, thoughts, comments? who we should get on in the coming weeks. I haven't had time to kind of figure out what who I'm going to bring on here. Yes, sir, Scott Wang. I think I pinned it. North Carolina, we got you. GreatMortgageBroker.com. Fill it out. Fill out the quick little 6 questions. It might be 8 questions now. We might be asking you more questions, but we'll be able to hook you up. All right, Sophie, we got a minute left. Hurry up. Wilson, I'm not sure when FHA loan limits are going to be released, but soon, I think. They usually follow the conventional stuff that's coming out tomorrow. I'm almost positive the conventional stuff's coming out tomorrow. FHA should follow soon thereafter. All right, Sophie, let's go. I've been in the office for 12 hours and I'm getting tired. While you're thinking of your question, no problem, Wilson. Kimberly, good to see you. We're about done for the evening. I want to give Sophie a chance. She's like, 1 question, please. Typing it out. Proof of life, Sophie. Are you still there? Send half of the question right now. There you go. I have primary with equity. Can I refi with cash out and buy a new primary property with these funds and earn twice the primary rates? No, you cannot. If you do a cash out refinance and try to go buy a new primary, the lender's going to say, no. Literally have this going on with a broker friend of mine. The lender is making the client refinance the one that they just did as an investment property. So the answer is no. You can do a cash out and call it an investment if you're going to buy a new primary. They both can't be primaries. You can't live in both. So you're going to have to do one of them as an investment property. Sorry. You do cash out refinance right now and move a year later, then you can do it. Then you can have 2 sweet primary rates, but not, one right after the other, unfortunately. Thank you for everyone that joined. I appreciate the heck out of you. Until next time, we gonna see.